Hello, ladies and gentlemen. Well, for weeks I've been telling you to completely ignore the model because it's just a mathematical risk off. And guess what? It's now in risk on. And that's because the moving averages have returned and crossed above one another. So, really, what you need, the lesson here is that you need an intelligent human behind the systems to actually ascertain whether what the system is spewing out makes any sense or not. And in this case, I've told you for weeks it makes no sense and to remain in risk on, and we will continue to be in risk on, I think, for quite a while. This news from France is very worrying. I don't know what to make of it at the moment because it is entirely independent on what the polling shows before the first election on the 30th of June and then naturally the second one on the 7th of July. It will be very, very volatile in all asset classes, but let's have a look at what could happen and probably what should happen. Let's start off with Europe because Europe is the one that is in the driving seat at the moment, and everything really is being priced off Europe at the moment in terms of risk. What did the Shats do? Well, the predictable thing in the Shats was to rally hugely because this is a far more existential crisis for the Euro and the ECB than Brexit ever was. France, Germany, and Italy are the three original signatories to the coal and steel agreement, and they are the heart of Europe. You cannot have an EU without France and Germany, which are the absolute core of it politically. Now, I don't think that France wants to leave the EU or the Euro or anything like that, but I do think there is a big danger that the markets start discounting that France becomes a country which does not respect EU rules. Simply because France has by far the highest deficit at the moment in terms of GDP as a ratio to GDP, but also because the far right and also the far left are populist parties which are going to basically ignore much more than the centrist parties have done all EU budgetary constraints, and therefore they might just go on a complete spending spree. If you get an election in France where Le Pen and the far right win, the only way that I can see them staying in power is if they follow extreme populist policies. What does that mean? That means they basically print. They do whatever they can to spend as much money in as short a period of time as they possibly can so that Marie Le Pen has a chance during the presidential election, which is, in a couple of years' time. So that will give them 2 years of print, 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 spend, 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 and prove that you can, govern. But what does that do? That makes the spread between the conservatively fiscal north and the, let's say it, less fiscally responsible France and possibly Italy go out. And the big danger here is that, yes, the ECB will try absolutely everything to keep these spreads together because they know it's an existential thing for them. But if the French government is actively working against them, then it becomes a seesaw. Now, I have no idea what the polling data between now and the first round of elections will be, and the markets will respond like yo-yos to that polling data. All we can do is look for some greater trends. I think that if you get, in inverted commas, good news about what the polls are going to be, and the market, the Schatz basically collapses, you want to buy it because it's not going to be the definitive. So this 295 to 299 area, however unlikely it is to be seen, to me is excellent risk reward. Why is it excellent risk reward? Because we know that the ECB has started an easing cycle. Whenever you get to these levels, you have overwhelming risk reward on your side. If nothing happens, you lose 20 basis points. But if something does happen, you make 50, 70, 100. And you can see that finally this line, which is the 200-day moving average of the yield, has actually started turning south. To me, this is significant. It just shows you that the pressure is all going to be on the downside in yields, and that any movement up is a movement which it should get bought. Whether we buy it through options or whatever, that's another matter. The 5s and the 10s are much less so. As you can see, it's a stable 200-day moving average. What does that tell me? It tells me that the 5s and 10s are already at their target. They are already where we are going to be if the ECB starts cutting rates. To me, it's all about how steep the curve gets. And at the moment, it's still within the ranges that it has been for a long time. I think what you need to do is you need to watch these levels, this 35 level in 2's 5s, and in 2's 10s, this level down at 25. It's only when they break that it tells you that big easings are on the way. Until then, you are basically playing the polling for the French election. And if you know what that is going to be or you want to speculate, great. I have absolutely no clue. I just know that the curve will need, if the news is bad, the curve will need to steepen like crazy. Because what can the ECB do? It can just ease. It can't do anything. And buy French paper, Italian paper, but that is not going to hold the market. They would need to buy hundreds and hundreds of billions, and I don't think they have the willingness to do that just yet. So what are you in effect trading at the moment? You are trading the spread between France and Germany and Italy. What happened as soon as the crisis started? We got this right. It got down to the level that it went to previously when there were crises, and this is around the 75 to 80 basis points. Now the question becomes, how does it trade from here? Well, I just know risk reward. It will naturally trade with the polling until the 30th. But who is actively going to buy huge quantities of it here? What is the upside? Well, your upside is that you return to, 50, 55. That is your upside. And so you could make 30 basis points. On the other hand, if things get really, really bad, you're looking, down here, 175. So your risk reward is not great. And I don't think that this is going to be much better than it is now, whatever the polling shows ahead of the election and the second round of elections as well. There might be some speculation after the first round of elections that the second round is going to be completely different because people are going to get scared and they're going to start voting for the centrist parties, or in any case not give either the far left or the far right as much an advantage as they might have gained in the first round. That is quite reasonable, but I really would not buy this spread, not even for a speculation, ahead of the first round. That I would buy it like 1 or 2 days before the first round and then see what happens, because that's the speculation. You buy, a small amount and then you see. But that is still best part of 2 weeks away, right? So I don't think that this spread is going to be volatile to the upside, but according to the polling, it could be very volatile to the downside. There still is no risk reward in buying it at the moment. I think the buying timeline is going to be much closer to the first round. Let's have a look at Italy over Germany in the tens. I think that this is not done because France and Italy are very similar. I know that the spreads are in percentage terms far, the starting point is far greater, but I would have thought that something like 172 would be a fair level to go against it if you want to go against it. But my timing is not until very much closer to the first round of the French elections. Because as I told you, I think that any disappointment that may be suffered in the first round, there's going to be speculation that the second round is going to be quite different. So that is the time that I think that you can play against this. I don't want to be a doomer at all. I think that Europe eventually will be fine and things won't be nearly as bad as the market fears. But I'm just looking for safe levels to buy these spreads and to think that they're going to come back in. And I just can't see that the timing to do it is now. I think in next week's video we'll have far more definition and we will have probably better levels and a better idea of how the French are going to vote, and therefore that week might be the time to put on some positions. At the moment it's just speculating, putting all your money on red in roulette. You might be right and you might be very wrong. And the risk reward here is just not good enough. I mean, where's the market going to go back to? 140? So what? You're going to make 18 points and potentially lose how many? It just doesn't make that much sense to me to go against it yet. The spreads against the US did exactly what I thought they would do. They've gone, this is 2s 2s, and 10s 10s went far less, but they still went. So what can one say about this? One really should be thinking that these spreads can go a little bit further, and then we see. I really don't think that there is any risk reward in selling this spread yet. I think we are in a 172-202 kind of range, and however bad things get, 202 is unlikely to break for the in the near future. And really this spread explains everything that happened in the US last week. You are having big pressure from Germany, from the core of Euroland for lower rates, and that is impacting the US. Okay, so what happened in the US last week? Well, independent of the European side of things, the Fed basically came out and said that they have no clue. What they did is they reduced on average the dot plot for 2024 to 1 cut, and then they pushed one cut into 2025, but they're looking for a total of 4 or 5 cuts. So they're saying that the terminal rate of their cutting cycle is going to be around 4%, which is exactly what I told you last week. And the market yawned. The market yawned because it doesn't believe that the Fed has any more knowledge than it does. The dot plots will change. They will change hugely according to the data. So there is really no more point in even looking at the dot plots or their projections for inflation or their projections for unemployment, because as soon as the data shows something different from their projections, they'll adjust the dot plots and they will do what they have to do. They are basically saying that the market is in control. The market will respond to the data and the Fed will follow. I really don't care what anyone at the Fed from now on says. They are just parroting what the market is going to tell them to say. The market is now completely in control, and this is when big moves can happen. I just look at the risk reward. To me, the odds of the Fed hiking rates are 0. The odds of the Fed needing to hike rates are also 0. Inflation is not accelerating. We can argue until the cows come home if inflation is going to be sticky and remain in the 2.5% to 3% range and not enable the Fed to cut, or whether we will go down to target very quickly and enable the Fed to cut. Well, what is the difference? The difference is 25 basis points on the twos, and potentially how many on the downside. If we are having a disinflationary slowdown at the moment, and some data does support it, and that is why I think retail sales this week is going to be extremely important, because if retail sales miss again, I think people are going to start putting a lot more credence to this disinflationary soft patch in the US economy, in which case the beneficiary can only be the short end. Look at twos, look at threes. Twos, threes, and fives are where the action is going to be, but naturally much more in twos, because when the Fed starts cutting, 25 basis points is going to do nothing. I think that their idea that they're going to be able to cut 25 here and then wait 3 months and do 25 there, if there is a slowdown, that makes no sense, because then the second part of the mandate comes into play, and 25 basis points is not going to move the needle on unemployment. If we go up to 4.2, 4.3 on unemployment from 4%, they're going to cut, and they're going to cut all the way down to here in no time at all. So I'm still in the steepening camp, although I'm naturally wrong, but I'm wrong. But I know why I'm wrong. I'm wrong because Europe has been doing what has been doing last week, and that has been causing the long end to do what it did. The long end came down because of Europe and the spreads against Europe, and also because people's positions got taken out. It is what it is. I know that the yield curve is flattening, but I know why it's flattening, and it does not worry me. Okay, so 2s, 10s are flattening at the moment simply because people need the duration. Their spreads against Europe are screwed. Europe made the moves it did, and they needed the 10s and they needed the 30s. That means nothing longer term. I still think that this curve is going to disinvert hugely at some stage. To me, any kind of weakness now in retail sales and employment data really makes the Fed have no choice but to cut. I want you to understand why I think the curve can do nothing but steepen, and I am going to die on that hill. Term premia are now negative. They're down here. Okay, this isn't updated. They're down here at around -5 or something like that, according to my calculations. I just cannot envisage a situation in which people are, as I've been saying this for weeks, are happy to have negative term premia on long duration with the enormous supply that we are getting and the supply which has absolutely no prospect of being cut anytime soon. In fact, it will only increase. Do yourselves a favor, stick to the short end on longs. The risk reward there is big. If you have a disinflationary slowdown, the Fed will cut and things will move 50 basis points. What is going to make the long end move were only little panic risk off moves like we had last week for the reasons that I've enumerated. But that doesn't last forever, and therefore playing the long end from the long side at these levels just makes absolutely no fundamental sense. And what doesn't make fundamental sense eventually is reversed. So this is real yields, and last week I told you that I was struck by that comment from Christine Lagarde about real yields. And I do believe that they want to keep real yields from taking out these highs. So I think this 215, 220 area is going to be very, very important to them. I think the central banks would try to do everything they can to stop real yields going higher. And because if they start taking out these levels, then odds are that we go back to these levels. And if we take those out, that's a big, big tightening in real terms. I don't think they want these yields to fall hugely, but I do think that they want them to top out around this 215 to 220 to 25 area. What does that mean? That means that tips are quite interesting again. To me, tips are now better than nominal bonds. And look at it this way. Say that inflation does go down to 2%. Okay, so these real yields can come down quite a bit in that case. But why would the Fed not cut then? Okay, so why would they not cut? Of course they would, and they could cut all the way to 4% in no time at all. And that tells you that the likelihood of the yield curve staying this flat is nowhere near as great as the likelihood that the yield curve eventually steepens. To me, that is obvious. I think that if we get real rates back down to 1.5%, or even this area around 170, okay, that is the signal for the Fed to start cutting big time. The dollar did the obvious thing, and risk off from Europe means stronger dollar, and really it means that the Euro USD really, can it trade down to 106? Absolutely it can, and I think it probably will over the course of the next week, but it'll stop there. I think the Euro USD is going to give us the best clues about what the French polling is going to be. I just can't see much strength in Euro USD for quite some, for 10 days or so until we get the first round of parliamentary elections in France. I think that will probably be the time to look for a bounce and buy something like a 106 to 109 call spread. Because if we're down here, I think you could easily get a big relief rally in the Euro USD when the results of the first round are come out, but certainly once the results of the second round come out. So, translating that to DXY, I think that this 106, 106.30 area is going to be very toppy, and for the time being, we're unlikely to break it. But if we do see it, I think we probably are at an extreme in all the bond spreads and the peripherals versus Germany, and that is probably a time to look to buy some. I think it's all going to happen at the same time, and I think that the Dixie and the Euro USD are going to give us probably a very, very good idea. I think if they try and take these stops here below 106, that is probably the time to actually start looking to counter it. Again, I find it very difficult to believe that A, the ECB is not going to try to help, but B, that the French as a nation are going to be as stupid as some people think, that they're going to allow their republic to fall into the hands of complete idiots. You know, it could happen, but I just don't think that the odds are huge, and therefore the extremes to me are a speculative buy. For what the potential of the euro crisis is, gold has had a very muted response. It keeps on failing at this 2350 to 2370 area. It hasn't really even got up to this 70 area, 72. And the moving averages are rolling over. I think the likelihood is still far greater than we go and we stop everyone out below this 2300 and we trade in this kind of area, this 2260 down to 2210. And the reason why I believe that is because A, I think that the long bonds are way overbought, and I think that at some stage they're going to come back, whether that is going to be after the French election, and that could be the timing for gold to trade these levels, i.e. after the first round of the election, when people start speculating that things are nowhere near as bad as they might have feared, but also because the response to by the euro really wasn't all that great by the foreign exchange. And let's have a look at gold over euro USD. So now this is gold in euro terms. I would have expected this move to have been far more impulsive than what it has been for the past week. All we've done really is return to where we were the week before. So this is not what, sort of euro crises are made of, it seems to me. And that is why I believe that the timing is going to be towards the end of not this week, but the week after, and that we are likely to abandon these levels and break down towards this 2000 level and then potentially bounce. When all the people who are buying gold in Europe because they're fearing this or they're fearing that and the spreads are ballooning, that is probably the time to go against it, and this to me will signal when we are potentially going to have big moves back in the spreads, i.e. the core versus the periphery. So the periphery gaining on the core when this gold starts trading below this level, this 21.23 in the gold in euro terms. When that happens, then you really should see a risk-on move, as it were. The spreads in between the bonds collapsing back in towards each other, and probably the euro being quite a bit stronger than it is at the moment, i.e. bouncing from that 106 level that I showed you towards 108, 109. So that could be a very good indicator, and I will be watching this very closely. Absolutely nothing to see in commodity land, TBC inside week. What are the odds? The odds are that at some stage we try and test this 2175 area, fail and then bounce. But for the time being, until it comes out of this range between 24 and 2175 and breaks it conclusively, I don't think there's very much to do in commodity land. Naturally, European equities had a dreadful week, mainly because of the CAC. But if we look at SPY over FEZ, it's really back at levels where it was in January of 2022, or let's say, sort of where the midpoint or where it has been trading for the past 2 years. It's really not done anything that significant. And that to me tells me that the market is really not all that worried about the situation. Naturally, things can always get more extreme as polling data comes out or election results come out. But this kind of behavior tells me that it's far more likely after a little bit of, panic here and panic there, to actually trade back down towards where it came from on a relief rally. So, naturally, the higher this goes, SPY is favored over FEZ, and the lower it goes, FEZ is favored over SPY. I think you might see this kind of level, 1120, and then you probably, in a month's time, you see it back down to here. So those are moves definitely worth having. So let's have a look at what the stocks are saying. So here you have the daily stocks and the monthly stocks. 48.49 was the level that I marked many months ago for you as a target, and then it just keeps on acting as support, doesn't it? So what does that tell you? That tells you that people aren't really selling European equities. Yeah, some people are getting stopped out, etc. But it's not the kind of selling that you would expect if people really believed that things are going to go and turn into a recession in Europe. It just doesn't compute, as they say. It doesn't triangulate. To me, it's far more likely that we just go and try and stop all these people out, because where are the stops now? I mean, anybody who hasn't been stopped out until now has, a stop here at 47.50, let's say, hoping not to get stopped out. Well, to me, this this level here at 46.85 is extremely unlikely to get taken out before the first round of French elections, unless I don't know what happens. So my call spreads are going to be struck from there. If we see it, I'm a big buyer of calls. It'll be very close to the 200-day moving average. I think the risk reward down there becomes overwhelming, because don't forget, if anything bad happens, the ECB will definitely act. They will try very, very hard to hold things together, and that, wherever equities bounce from, should really take them back to at least this level. I mean, let's assume that I'm completely wrong and things go way south, which I find very hard to believe, by the way, then when the ECB acts, I would have thought they're bound to come to at least this kind of level, and therefore you're not going to lose that much money. So the risk reward becomes, sizable. Now, it could easily be argued that DIA over FEZ, either Dow over the FEZ, is far more comparable than over the SPY, because they're sort of old economy stocks. And if you look at that, really we haven't gone anywhere. So Europe is hardly being abandoned. And I think if we see a little bit more, that gives you a signal that Europe is probably a bit becoming a bit of a buy. If we see these levels around 786, and I'll let you know next week, that would actually almost perfectly work against that just below 4,700 level in the stocks futures. Might be a little bit above, but I think it's definitely worthwhile as time passes and we get closer to the first round of elections, and as these spreads go a little bit further, it pays to put on some option plays, and that is actually why volatility is going to, remain high in Europe, because everybody wants to buy some options. We're coming up to the quarterly OPEX. Absolutely zero chance that these markets in the US are going to get clobbered until and unless you see this 52.50 to 52.60 area even threatened slightly. There is zero pressure on this market, and as you can see, it just keeps on going up and really trading at the top of the Bollinger Bands. It'll come back down, go back down towards the these Bollinger Bands, and then keep on coming up and maybe go sideways for 2 or 3 weeks and then continue its way up. That is why I think that you want to buy some European stocks on a real dump, because I just can't see that the US is going to be challenged in any way, and that is precisely because NQ is just a monster. Just no reason to sell NQ whatsoever, and really, what can I say? That it has no resistance above, but what is likely to happen is that you are going to see times when it comes back and challenges these Bollinger Bands where it came from. So around the 19,100 area, something like that. It will, next week I don't think it happens, but at some stage over the course of the next month or so, I definitely think it'll happen, because it always happens. The market always comes back and challenges the point on the Bollinger Bands, on the weekly Bollinger Bands that it broke, and that becomes support. So wherever it goes to, it'll come back to 19,100, 19,200, but that doesn't mean anything to me. The trend is so strong in NQ to the upside that I just don't see why anybody wants to challenge it at the moment. I just want to have a final word about SPY TLT and triangulating with what I said at the beginning of the video about the Fed will have no alternative but to cut if the economy starts going worse, i.e. if the unemployment rate rises. Because I don't think inflation is going to be a massive problem, because I don't see commodities rising hugely, and I just don't see any acceleration or evidence or reason for inflation to accelerate, and therefore for the Fed to even think about tightening, let alone doing it. I think the odds there are absolutely zero. But when would I start getting worried about equities in general? Why? Okay, if we start now breaking this SPY TLT level of 556, then the market is telling you there's something to be worried about. This is the range that we've been since basically mid-March. And where were we in mid-March in SPX and in NQ? We were around the 18,000 level. And in ES in mid-March, we were below that, around the 5,100 level. So all we have done since mid-March is go up and down with the bonds, and really if the bonds now start going up relative to equities and we start breaking this range, that will be the first reason that I will see that we are in trouble as far as the economy is concerned. Until that happens, the market is telling you this is nothing but normal gyrations, and I just can't see that this move, if it were to happen, would be caused by TLT. To me, TLT is priced in the kitchen sink as far as weakness in the economy is concerned. It has to come from SPY. So that is what I'm watching to tell me that we are moving towards any kind of risk off. And until that happens, I just don't think that there is any need to worry about the economy in terms of, a very bad soft patch. A soft patch is what we need to enable the Fed to cut, and that is good. But, we don't need any more than that. That's a soft landing, in essence. To sum it all up, I don't think next week is really the week to put on any big trades. We have a bit of a holiday, and then we are ready for the first round of the French elections. And I think all those positions that I talked about, long stocks and trying to look for a narrowing of the spreads of the periphery towards the core, are best done not next week, but the week after. We will have far more definition and we'll have far better insights into how bad things can be. I'm just not a doomer about it. I think the French as a nation are far too sensible to do something completely stupid. It can happen, but I think the odds are against it, and I'll bet against it. Thank you very much indeed, and tweet you tomorrow.